Want to buy a home in North Texas? Well, to make the most informed decision, you'll want to know all your options for the various types of mortgage loans available. In this video, we will discuss the 7 most common types of mortgage loans available to help you decide which option best suits your needs. Hello, and thank you for tuning into this segment of Let's Talk Real Estate, where we are discussing mortgage loan financing. I'm Mark Meras, one of the co-founders of Paragon Realty Advisors located in Uptown Dallas. At the outset, you may be confused by all the options that are available to you because there are many types of home loans, each one having specific advantages and disadvantages, and depending on the loan type, they may differ in terms of the qualifications and criteria needed. Since there are numerous types of mortgage loans, we have trimmed it down to the 7 most common ones. Keep watching to the end to provide you with the information you need to make an informed decision when deciding the best loan option for you. The first 2 types of mortgage loans that we will discuss are fixed rate and adjustable rate mortgages. The easiest way to distinguish the two is to define their time frame and how the interest rate changes over that course of that period. For fixed rate mortgages, there is a longer period when the homeowner's interest rates will remain constant. Adjustable rate mortgages, also known as an ARM, also have a specified time frame when the interest rates will not fluctuate. However, it is shorter and will change to an adjustable interest rate afterwards. About 90% of home buyers choose a 30-year fixed rate loan, making it the most popular mortgage type in the country. As its name suggests, the interest rate does not change over 30 years. This means that borrowers can enjoy lower monthly payments because the mortgage is stretched over a long time. This arrangement also protects homeowners from potentially drastic spikes in monthly payments due to fluctuations in mortgage rates. Most lending institutions also offer mortgage terms of 15 or 20 years. However, borrowers will need to repay the principal in a shorter time frame, so monthly payments will be considerably higher. The advantage of shorter term loans is their lower interest rates. Each mortgage payment repays a larger fraction of the principal, so 15 and 20-year loans cost significantly less overall. An adjustable rate mortgage, or ARM for short, starts with a rate that remains constant for a specified period, but it switches to an adjustable rate for the remainder of its term. Also called a teaser rate, it is initially set below the market rate of most comparable fixed rate loans. Nevertheless, it is expected to rise at regular intervals called the adjustment frequency. ARMs are significantly more complex than fixed rate loans because adjustments are tied to indexes like treasury bills or certificates of deposit. ARMs start much cheaper than fixed rate mortgages, at least for the first 3 to 7 years. However, monthly payments can change frequently and subsequent adjustments will follow current market rates, not the initial below market value. Fixed rate are relatively safer and more predictable for most, but variable rates can be advantageous for short-term homeowners who expect to move in a few years. Aside from fixed rate and adjustable rate loans, mortgage lenders also offer home loans such as interest-only loans, FHA loans, VA mortgage loans, jumbo mortgages, and USDA loans. When looking at interest-only loans, they require that the borrower pay just the interest for the first several years of the term. In contrast, fixed rate and ARM loans require monthly payments to amortize both the principal and interest. Once the initial period ends, the borrower will start paying both the interest and principal. You can typically see interest-only loans as a structure of repaying ARMs. For instance, a borrower may pay only the interest portion during the first 10 years of a 10-1 ARM agreement. After the 10th year, the rate will adjust annually and you will start paying for the principal as well. The bottom line is that interest-only loans are highly complex and not appropriate for most borrowers. You can enjoy low monthly payments during the interest-only period, but costs will sharply rise once they are over. The next type is the FHA loans, which are guaranteed by the Federal Housing Association and issued by a government-approved lender. Designed to help low to moderate income borrowers, FHA loans allow down payments as low as 3.5% if you have a credit score of 580 or higher. You can still qualify if you have a credit score between 579 and 500, but you need to make at least a 10% down payment. Would-be borrowers also need to have a debt-to-income ratio known as DTI of 50% or less to get approval. The DTI is a percentage of your pre-tax income that you use to pay student loans, auto loans, credit cards, mortgages, and other debts. Regardless of the down payment amount, FHA requires borrowers to pay for mortgage insurance to protect the lender in case of default. Next, we have VA loans. VA mortgage loans are insured by the U.S. Department of Veteran Affairs, often just referred to as a VA. Like conventional mortgages, they can be issued by banks, private lenders, and credit unions. Active military personnel and veterans who meet the required length of service can qualify for a VA loan. Surviving spouses of service members who died while on duty are also eligible. Unlike most other mortgages, VA home purchase loans do not require mortgage insurance, and down payment interest rates also tend to be lower than FHA home loans and fixed rate mortgages. The program also offers cash out refinancing to replace a conventional mortgage with a VA loan. Borrowers can also finance the cost of home improvements. VA loans have some limitations and potential drawbacks for some borrowers. For example, you cannot purchase a vacation home or investment property. A VA-endorsed appraiser must first evaluate whether the property meets the department's standards. Lastly, the borrower also needs to pay funding fee to cover the costs of foreclosing in case a mortgagor defaults. Moving on to jumbo loans. These are loans that exceed the amount set annually by the Federal Housing Finance Agency, also known as FHFA. If the price does not conform to FHFA thresholds, you need to have a solid credit score of 700 or higher. Also, the lender may require that you put away up to 12 months of mortgage payments on a cash reserve. Since you are borrowing a large amount, there are additional fees that can lead to steeper closing costs. The jumbo mortgage lender can also require at least 2 appraisals on the home's value before approval. In contrast to jumbo loans, USDA loans are backed by the U.S. Department of Agriculture. USDA loans are designed to help low-income applicants purchase homes in rural areas and some suburbs. The program allows you to obtain loans directly from USDA or a participating lender with interest rates as low as 1%. To qualify, you must have a debt-to-income ratio, known as DTI, of 41% or lower. USDA will likely consider higher DTIs if your credit score is at least 640. USDA also issues home loans to applicants deemed unable to secure mortgages from traditional channels. These are borrowers who are below the low-income limit and without decent, safe, and sanitary housing. What is the best type of mortgage loan for you? As the saying goes, different strokes for different folks. Home buyers differ from one to another. As such, these discrepancies define the type of mortgage loan that best suits their needs. If you want an interest rate that is fixed for years, choose a fixed rate mortgage loan. For those who are looking for a more flexible option, an interest-only mortgage loan might be suited for you. This is also great for Americans who are looking for real estate properties to invest in. All in all, the best type of mortgage loan is the one that fits your personal preferences, circumstances, and financial capacity. An expert's advice might also be helpful in deciding which loan is most suitable. As such, it is important to speak with a qualified mortgage professional before you begin house hunting. That way, you'll have a clear understanding of what you can and can't afford. If you'd like a referral to a trusted lender or have any real estate questions, we are here to help. At Paragon Realty Advisors, we strive to be your one-stop shop for all things real estate. To explore all that we have to offer and find more educational content, please visit us at www.paragondfw.com. If you found this video helpful, make sure you give it a thumbs up, hit the subscribe button and notification bell, and you'll have access to all current and future content. And finally, make sure you leave a comment below. We'd love to hear from you. See you in the next video. All the best.